business owners are in a mad rush to get their stuff to the CPA. Like, they don't even care if it's correct or finished. They're like, just get it to the CPA by the 7th of January. And it's like, whoa, like, I'm an accountant and we keep real accurate books. And I can't even get all my stuff to the CPA by the 7th. Why? Because I'm waiting for the W-2s. I outsourced payroll, so I don't have to worry about it. And I'm waiting for the fourth quarter reports on the W-2s. So the CPA needs those to be able to do your tax return. So you can't just rush off and give everything to the CPA. Now, if you don't have employees and you don't have to wait for W-2s, that's good. You still need to pay attention to maybe 1099s that you are getting in the mail, because your 1099s need to equal or be less than the amount of money you're reporting. Basically, you can't have your 1099s report more money than you're reporting. The government will call you on that. So anyway, before we send stuff off to the CPA, we really do need someone to do a balance sheet review. Now, a balance sheet is the most important financial statement you have. And as business owners, I hope you all are working on embracing your balance sheet and understanding it. It shows your assets, your liabilities, and your owner equity. That whole list needs to be reviewed. I mean, it might be that you only have 3 accounts, right? But you need to look at them. You need to look at the report and see if it's correct. If you have negative $50,000 in employee draws, it's probably not correct. It's a negative number. Most of the time, negative numbers shouldn't appear on financial statements. There's only a few exclusions to that. So seeing negative numbers should be a red flag. But before you give stuff to the CPA, you really need to make sure it's clean every single year, because things on the balance sheet stay on the balance sheet and they just stay there and stay there and stay there. So this brings us to our next topic, which is reconciling. Part of reviewing your balance sheet is reconciling accounts. You can reconcile bank accounts, credit card accounts, loan accounts. And so what reconciling is you take your third-party document, like your bank statement, and you take your accounting software, and you tick, 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 mark them off, confirming that what is on the statement from a third party equals and matches what is in your accounting software, okay? But that's only part 1 of reconciling. That's the first step. There's a second step. And what's scary is I'm running into more and more people that are sitting in that bookkeeper chair that don't even know you're supposed to reconcile the credit cards. Like, they only know that you're supposed to reconcile the bank account. And so credit cards not reconciled for 2 years, right? And the scary part about that, specifically with credit cards, is who's watching for fraud? Who's watching for the fake charges that might come through on that card if no one's reconciling? If no one's reconciling, then no one's probably looking at the credit card statement. And if no one's looking at the credit card statement, is anyone paying attention to the credit card enough to notice if you have fraudulent charges? So that's a really good reason to reconcile the credit card account every month. But like I said, I'm running into more and more people that are being hired as bookkeepers that don't even know you're supposed to reconcile the credit card accounts, and just so scary. So the second part of reconciling, part 2, which vast majority of bookkeepers don't know about, but we can teach them like we're doing right here. Hello, fellow bookkeepers. There's a second part. And the second part of reconciling is dealing with the things that do not clear. So after you tick, 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 mark everything off, then what's remaining? For credit cards, my rule, much like the military, is no transaction left behind. There should not be any uncleared things in the credit card account. They clear immediately, right? They're credit card charges. And so if you have charges in your accounting software that aren't on your statement, either they're dated incorrectly, or they're a duplicate, or they're just a complete error and never should have been in there in the first place. So what to do? what my team has as a rule is if something doesn't clear for the credit cards, they search for the dollar amount to see if it's a duplicate. Some businesses have 3 or 4 credit cards, and you'll find that the charge was entered in US Bank credit card, and then somebody noticed that it was missing from Capital One, so they added to Capital One on the fly without the receipt, and now you've got 2. And that's why it's so important to use things like receipts to do data entry, so you don't end up with things like that. So what to do? When you have, let's say, a deposit that isn't clearing the bank, that's a huge deal. There's money missing. Where did it go? Why isn't it in the bank, right? What happened to it? I had a client who was using their phone to do deposits, and some of the deposits weren't going through. And they didn't realize it until we reconciled and said, hey, you've got a bunch of deposits missing. Well, it turns out it's because their app to do deposits, it didn't take some of the deposits. We're talking tens of thousands of dollars just went missing. So deposits should clear in the month that they're deposited. The only exception would be if you have something like on the last day of the month that ends up getting reported at the bank on the first day of the following, right? So it's at those cutoff dates are the only thing we would normally leave behind. But what about checks, right? So I know more and more people are using ACH, which mitigates this issue. But if you have a paper check that doesn't clear, what do you do about it? Well, if it doesn't clear in the first month, we just are like, okay, recognize it didn't clear. But if it doesn't clear in the second month, that is a call to action. And it is a call to action for 2 reasons. The first reason is because we want to make sure this gets deposited and is off our books. I've done reconciliations where there's stuff going back to 2014, like 11, 12 years old, and it's just sitting there. Little zombie transactions just stagnating. We don't want those. We want clean books. So what we do when it doesn't clear in the second month is somebody should be reaching out to the vendor or employee and saying, hey, do you have that check? Could you cash that check, please? Right? If it doesn't clear the third month, we have to reach out again. What about that check? Did you find it? Do you need a replacement check? What's going on? Right? So first of all, the goal is we want clean books. We want the stuff gone, right? But the second reason why this step is important is because of unclaimed property laws. So in Oregon, the unclaimed property laws say that if you owe someone $100 or more, you have to prove that you tried to reach out to them at least 3 times. And then if they don't cash the check in all that time that you worked on trying to get them to cash the check, if you can't get a hold of them, you can't find them, they never cash the check. Unclaimed property laws say that you then need to send that money to Oregon. In my case, Oregon, because I'm in Oregon. $100 or more in Oregon. So if I had a $100 check, never got cashed, I reach out, can't get a hold of the person, technically I have to. Now, the bummer about this, people, is the moment you start with the unclaimed property submissions, you can't stop. The first time you submit triggers this thing where then you have to be submitting every single year. And, for most of us, it's rare that we would need to report, right? So what do you do? When your reconciling checking account check is not clearing, you try reaching out to people. The first thing that I would actually do with this paper check scenario is search for the dollar amount. Is it a duplicate? Maybe a check wasn't even created. Maybe we ended up paying with credit card, right? Or maybe it got entered twice. And so it's in the system twice and it really just needs to be voided. And that's the thing. During the year, throughout the year, we can do things like void something that's inaccurate. But once we close the books and we send stuff off to the CPA, you can't change the past at that point. So then you, the bookkeeper, or getting help, someone needs to know how to reverse entries. So if that $100 check sits and sits and sits and nobody does anything about it, and now it's 2 years later and somebody's finally like, boy, these books need to be cleaned up, and they go in, you can't just void that check. It's too late. The books are shut. The CPA already put it on a tax return. So then you have to do these reversing entries, and you have to know how to, like do a journal entry and know that your debits and credits. And that is definitely bookkeeper/accountant world, right? You should not expect your data entry clerk to know how to do adjusting journal entries to revise the past. Like, that's just not something that's reasonable. The takeaway here, folks, of the 5 things that people get wrong is they either aren't reconciling at all, so they have like a line of credit with the bank, never been reconciled, or they do reconcile, but they only reconcile in the way that AI can now reconcile, or when you turn on the bank feed, how it preps the reconciliation. An AI agent could go in and mark off all the things to match with your bank statement, but the AI cannot deal with the stuff that's not clearing. You need a human. And so there you go. Your data entry clerk or bookkeeper is now going to be the human that is in charge of following up on these things that are not clearing. And we need to do this every month. We need to work on this cleaning every single month so that we're not having this disaster January and February trying to get the books cleaned up. And your CPAs are doing a lot of work in the background that I don't even understand. You don't understand. It's magical stuff. We don't want to force them to wade through chaos and zombie transactions and garbage to try to get to your information. And that's why in a previous video I mentioned that you really, as business owners and bookkeepers, but business owners specifically, you really should be looking at those adjusting journal entries that the CPA did, because if you have more than 2 to 4 of them, it's a sign that there's something wrong with the bookkeeping. There's something wrong with the way it's being done. And that doesn't mean you have a bad bookkeeper or a bad data entry clerk. It means that there's something going on with your systems that needs to be revised. There's a problem with your systems. And as we do things like add apps and do integrations and things like that, you're compounding the probability that you will have these kinds of issues. And you need to have someone on your team with the skill set that can resolve and fix them in the fiscal year, right? Not after the fact, but during that fiscal year, so that you can send stuff off to the CPA with clean information. Now, I'm telling you this, and I'm hoping that you all go back to your accounting software after you watch these videos and you start looking at things. Look at your balance sheet. Do the balances look within the realm of reasonable? There are reports called reconciliation reports. Look at your reconciliation report. It shows you what's cleared and what's not cleared. And that aging not cleared stuff is what we have to tackle before we give stuff to the CPA. Now, what could happen with me telling you this is an overzealous business owner or bookkeeper is going to go in and start reconciling, maybe for the first time, or next time they go in to reconcile, they're actually going to pay attention and notice all the uncleared stuff. And they're going to start deleting things. Worst plan ever. We cannot go in and delete or void the past. We can do those kinds of things in the fiscal year, right? But not prior fiscal years. And if your bookkeeper is told by you that the accounts have to get cleaned up and anything old or aging has to be dealt with, and you leave it up to your data entry clerk level bookkeeper, and they go in and start voiding or deleting stuff from 5 years ago, you are going to really annoy your CPA. Why? Because they're changing retained earnings, which is the top of our next video. See you on the next one.